Cool. Hello, everybody. This is the Equity Live show where we record an episode in front of a live audience and stream to all the platforms. So welcome to this experiment. Welcome to our first time doing this. And so this is the pre-show. We're going to go through the script. We're going to chat a little bit about what we're going to chat about. And then the Equity team will take us into the recording. So welcome to us all.
Yeah, we're so glad to have y'all here. So we're going to dive right into the script. Just a couple things that I wanted to ask before we start the show. Funding rounds, I did a little swap of the two at the top. So we're going to start with Moss. Natasha, what's the front? Moss? Great. Go to Alchemy and then go to Cook's Venture. On the themes, I put the flow at the top of those sections so that we all had that to refer back to.
Right.
Otherwise, nothing else changed in the script since we put it together. Were there questions that came up for y'all while you were working through?
I just saw Marianne's comment, quote, "What the actual fuck?" That's amazing, Marianne.
Very excited.
You're muted, Marianne, by the way.
Yeah, I know. Well, there was really no other reaction in that one.
We'll get to what she was surprised by, but sorry, Grace, back to you.
No, that's great. If any other questions came up, I guess kind of to that point, Alex, one thing that came up there, the Lyft and Uber earnings.
Yeah, I was going to ask.
Yeah. Are those currently out? Are those coming out? And are you going to talk us through those there?
They came out 2 days ago and yesterday after the bell. So I have the data on that. It matches up to the general point that post-pandemic we're seeing kind of a differentiation in results, because Lyft said kind of softer Q1, Uber seemed to be a little more bullish, but I mean in general we are seeing kind of a deceleration from H2 21 growth rates. So that's kind of fitting to the thesis of the section, I think.
Okay.
Amazing.
I was going to say, I feel like from my scan of the Uber story, it sounded like Uber was doing well. So does that kind of contradict our, I guess, pre-point of all tech stocks struggling?
Well, the idea was that we're seeing a split, because Microsoft and Alphabet had great results. And then we saw Spotify, PayPal tank, and then Facebook tanked, Amazon did well. And so to me, it's no longer kind of a unistory in which everyone's just up and to the right. It's more of a differentiation point. And so Peloton kind of fits into that matrix.
Okay,
Yeah,
cool.
Sounds good.
Amazing. Super helpful. Did other questions come up on any of the other themes before we start, or are y'all feeling ready to dive in?
I just have one question. Who's taking point on the theme 2, the Lolita section? Is if I'm handing off to somebody, who should I hand it to?
Yeah, my thought had actually been Natasha. Yeah. Sorry, if you can introduce that would be great. I'm just going to put your name there.
Cool. Yeah, happy to do that.
Okay.
And I guess like also on the theme section, Insurtech, like is the debate or like what we're going to unpack kind of I guess getting into the difference between private market investment booms and public market performance, or is there something else as well?
That's kind of like, all the public Insurtech companies are not doing well, but Insurtech keeps getting funding.
Yeah.
So what's up with that? I think that's kind of the
what's up with that?
What's up with that? Yeah.
Right. Right.
Yeah. It's an SNL joke, Natasha. Right there. Okay.
I missed that one too.
Early.
That show it's too late, even on a Saturday.
I just don't care. I wish I was that person, but I'm not.
Wow.
All right.
Are you all ready? Citizens.
Are you all ready to get into it?
It's opposite. You're staying up later than me, Alex.
Yeah, right.
Y'all are a bunch of senior citizens. I'm not.
No.
I'm a sleep-deprived teenager.
Yeah.
Opposite of the joke that we normally do. So I'm confused.
Okay, who wants to do a show?
Yeah.
I think we're ready.
Let's do a show. Okay. Let's shake it out. Let's take a deep breath in and out. Everyone is recording.
Yes.
Yeah.
All right.
Yep.
Okay.
Equity Live in 5, 4, 3, 2, 1.
Hello and welcome back to Equity, a podcast about the business of startups where we unpack the numbers and the nuance behind the headlines. My name is Alex, and before I introduce the crew, I'm going to say we're live. We're live right now. We're doing this live. We haven't done a live show in a long time, but this year we're going to do a live show every 2 weeks. So Natasha, Marianne, hello, welcome. And how much more effort did you put into your appearance today than you usually do? I put on a shirt with sleeves in honor of
Yes, that's true. Not a tank top for once.
I know. This is effort. Natasha, how are you feeling?
I'm the same boat. Like, I'm not drinking coffee today, which is questionable, but I did brush my hair. And I wore a shirt instead of a sweatshirt. So I think like I'm evening out my pluses and minuses right now. Marianne, how are you feeling?
Yeah, about the same. I tried to like take off the pajama top for once,
We're doing great.
Yeah, this is the most formal Equity has been in some time. The pandemic really has brought us down to slacker casual, maybe is kind of what we usually look like. Anyways, we're here with all of our friends. We're on a bunch of different platforms. If you are catching this on your podcast player, we'll tell you about it later on, but every 2 weeks we'll be live on Thursdays. And so with that, I think we can jump into the topics. Yeah,
let's do it.
All right. Today we're talking about funding rounds from Moss or Mose? Moss, Alchemy, and Cook's Ventures. Then we're going to talk about Peloton and the first quarter of 2022 and what we are seeing out there in the economy for tech companies. We're going to riff on pitch deck consultancy and how the venture capital game may not be entirely fair. And so we might need to make some changes to norms. And then we're going to talk about Insurtech. And then at the end of this, we're going to take questions about whatever. So it should be an absolute blast. But to kick things off, Moss, Natasha, what's going on?
Yeah. So Moss is a really interesting startup. I've heard about them for a long time, but I haven't had the chance to write about them just due to bandwidth. So finally, the worlds collided and I was able to write. So Amira Yayawi founded Moss around in 2017 to help students get access to scholarships. She kind of just she spent her business really connecting them to capital pools and helping them unlock it. And it kind of went back to her roots as a activist. She wanted to like really focus on financial freedom and access in her startup. But this week, or I guess last week now, Moss raised a 40 million Series B at a 400 million valuation to evolve from just a marketplace that connects scholarships to students to actually being a bank made for students. And so I had to bring it up on the show because it fits into our theme of everything is a fintech. But this one
exactly what I was thinking.
So I have a question about this. It started off as a way to access scholarships, by my understanding, because the goal was to make it kind of just easier for students to graduate school without as much debt as they might otherwise have. What's the direct link between here, we're going to help you get financial aid, and here, we're also going to be your bank? Like, to me, like they're related, but there's still a bit of a jump there from one to the other.
It's definitely a jump. I think that they started the conversation with students about money. They taught them about like trust and kind of like getting access to these pools that maybe are often either hard to find or hard to apply to. And so I think Moss spent its first years doing what now I think is kind of like the cheesy route, which is like building using your community. So like it really built up kind of helping its community access money. And now it's using kind of the trust that it built to hold that money as well. And I talked to Dina Shakir from Lux about this, and she was basically saying like before they kind of sat tangentially on the side of financial access and inclusion, but they're clearly trying to be a more primary bank now for students as a result. If that answers your question, Alex.
Yeah, I have a couple of questions, of course. So I'm curious as to the decision behind it. Like, were they hearing from these students, we wish you offered more financial services, or was it more of a like pivot to were they having revenue struggles or what? I mean, because I'm seeing more and more banks that are targeting very specific demographics out there. So I'm just curious, like the reasoning behind the decision.
Totally. So kind of like I just said, I think it felt natural to evolve to this point, like after they went from like, I guess it's like, yes, connecting students to money is a business in and of itself. They charged a fee, but like a few years in, they were able to grow their ambition. And so my read on it, Marianne, as I think you're kind of alluding to, is it had to be partially changing their ambition on how big of a company they wanted to be. In the story, she told me that like their market cap is now 10 times higher than we were before. Mm-hmm. And that's because they're changing their business model. Before they used to make a fee after kind of helping students access these scholarship dollars. And now it makes a fee through, through having a card. So I think like, through interchange. And so I guess like, I'm thinking like, it's not coincidence that the startup is trying to find a way to like give more lifetime value to the students it was like first serving just for like that 4 years, stuff like that.
One more point about this is that the attach rate, if you get a student to join a bank, is pretty long. So I went to school in Chicago, and we had banks that were local to like the campus. And I think it was Citibank was like the official banking partner, which is a ridiculous thing for a university to have, but hey, what can you say? And so I ended up opening an account there, and I still have that account, and I'm old now. So like, I mean, you can end up in your student years forming these long-term relationships. And so for Moss, I presume they want to get students early and then keep them. My question is, can you build a bank that works for kind of adult life, and that also is attractive to students in this particular context? I don't know, but the lack of fees they're charging makes it sound at least appealing, though, you know, curious from a revenue perspective.
Yeah, I think that aha moment feels like kind of similar to what she was saying, in that students really stay with their bank. So why not, if we're already building relationships with them about their money, kind of bring that in there. And then also customer acquisition cost. Like if the reason people are coming to you is for money, it's not that much energy for you. So I feel like it makes sense from a fintech perspective, but I guess I do see like so much competition out there. Marianne, you're covering these like targeted banks all the time. At a certain point, like there needs to be something that will differentiate them from Moss. I think they believe it's their community, but are there any other things that could either help them make it or break it?
Well, I'm also curious, like, where are they in this process? Like, do they already have banking customers, or is this something they're planning to launch?
They already have banking customers. Yeah. I don't have the number off the top of my head, but they've kind of opened up a significant amount of banks. Over 100,000 students opened accounts with Moss in the first quarter of launch. And she estimates that the growth makes Moss the 10th largest neobank in the United States.
Wow. That's kind of impressive.
That explains why Tiger signed up. 100K in the first quarter. Sure, we'll put 40 million into that. Apparently, that's a Series B. Why not?
Not bad at all. Yeah, so it seems like they definitely are onto something.
Yeah. Okay, but a $400 million valuation is chump change in the crypto world, where rounds are worth $400 million. So let's flip the script and talk about Alchemy, which has brewed up a really interesting round, a $200 million Series C1. Marianne, what's going on here?
Yeah, so this is the third time I've covered Alchemy in like a 9-month period, which is like crazy, even by all the funding frenzy we've been talking about now for months. Let's see, they're valued at $10.2 billion in this latest round, which is like insane. They're a decacorn. For some context, last April they were valued at $505 million. So this is, let's see, what was the math?
105 to, it's about 10. No, it starts about 20.
20,
right?
Almost 20 times increase in valuation in like a 9-month period. So what do they do? Like, why are they so hot? In summary, they aim to be the de facto platform for developers to build on Web3. They're basically trying to do for blockchain and Web3 what Amazon Web Services did for the internet. And so they seem to be doing really, really well. To give you some idea, they said they've seen a 3 times growth in the number of teams building on their platform since they raised last October. They power almost every NFT marketplace out there, including OpenSea, which has also seen a massive jump in valuation and revenue, which, you know, kind of makes sense. So yeah, they're doing pretty well.
I was digging into like the stories that you've written about them over the years. I think Josh wrote one as well. And people were comparing them to like the Microsoft of cryptocurrency. And we even saw, I think in your story, one of the investors who was participating in the round kind of compared their growth trajectory to that of Microsoft, which to me was just a reminder that we still don't have normal benchmarks to compare a company to Alchemy to, which makes investors' jobs more interesting, but also makes these valuations, I don't know, like still surprising in a way. It's not like we've had like, there's no precedent for something like Alchemy raising.
Yeah, I would say another interesting thing about this startup, it was founded in 2017 by Joe Lau and Nikhil Viswanathan, and they started out of their apartment. I don't think they had any idea it was going to grow to this size. Like they were just super passionate about what they were doing, heads down. It ended up blowing up. And, you know, now I'm hearing investors are like clamoring, like just knocking on their door to get in and invest on the company. So, I think they've even had to turn away a lot of people, and they're profitable.
Wait, well, did we niche down to what type of profit? Because I just covered Uber and Lyft, and I just got a bunch of adjusted EBITDA shoved in my face.
Alex is hurt. He has trust issues.
I've been burned.
Good question, but they are still a private company. They didn't get into super graphic detail, but
Marianne, don't give them space to be obfuscatory, because we should demand more. If they're going to claim profitability, they should back it up with telling you what it is. And Chime did this. They said they were EBITDA profitable like a year and a half ago. And I asked, adjusted EBITDA or real EBITDA, and the real EBITDA, whatever. And they said real. So there's proof you can share.
Would you rather though, Alex, like get profitability? Like, I guess, would you rather a company say decline to comment, or would you rather them say profitable or not profitable?
I'll take profitable so I can make fun of them versus no comment. Like, why not be specific? If you're going to, like, my car is so fast. How fast does it go? I won't tell you. Like, I mean, it's ridiculous. It's schoolyard bullshit.
I don't know if they would tell me, to be honest with you, because we really didn't drill down into it, but I will be happy to ask. And, they've been fairly forthcoming so far. So
true.
I'll keep you posted.
So a couple things about this. One, I think we're seeing the infrastructure play. If you're going to go support an industry, do you sell the picks and shovels, or do you actually mine for gold? It's classic kind of like who you invested in. So to see Alchemy get this much money, not a big surprise. Here's the question though. I was reading through our notes on this before we recorded, and they're seeing a lot of kind of like on-chain volume growth, right? They're helping power a lot of the blockchain economy, which is great. And that's really cool. But a lot of that comes from OpenSea, because OpenSea is an Alchemy customer. And OpenSea is also being valued on rising transaction volume. So are two companies getting the same points for one bit of work? Kind of my question.
It's a good point, Alex. I mean, they're telling us that they saw $105 billion worth of annualized on-chain transactions so far, and that's more than double the $45 billion figure they told me or quoted me in October, which is a lot. And you're right, probably a good amount of that's coming from OpenSea. So the question then becomes, is if the NFT craze kind of dies down or goes away, how much is that going to impact Alchemy?
And we're not just picking on crypto here. I mean, this was the question with Affirm and Peloton, because Affirm's growth was partially predicated on Peloton's growth. And as we've seen from Peloton recently, growth can go away with a key partner. And so that you can become kind of over leveraged on a single thing. Anyways, I think we're going to hear more about Alchemy throughout this year, Marianne. And there's other companies doing this too, like Fireblocks, I think, is also in a similar space.
Yeah. There's a few of them. I don't remember their names offhand, but I can look them up real quick. But
no, you're fine.
I think one question I continue to have with even a company like Alchemy, because even though it's like, I guess, supporting an OpenSea, Adobe, Dapper Labs, and CryptoPunks, some of like the household names, if you are even slightly tuned into crypto, is like, do startups graduate from them ever? Like, does it have the ambition to be like actually the AWS of crypto or of blockchain, or is it just helping these like newer platforms? And I'm sure there's no yes or no there, but that's just kind of like my big question going forward.
I think they really want to be the AWS, for this industry. And, will they do it? I'm not sure, but they're certainly going seeming forward with like explosive growth. And I'm really interested to see how things play out. I knew things were like hot when I talked to them last year. I didn't quite expect a $10 billion valuation less than a year later, though.
$10 billion pre, because it's 200 and then 10.2. So it's literally a flat 10 billion pre-money valuation. They sold like essentially no stock for $200 million. I mean, that's like the
It's super crazy. Impressive. I think before this, they were building an app called Down to Lunch. And it was like this really like scrappy, like they didn't want to raise money. They were like working in their apartment and off of like cardboard boxes. And I think there was like a really interesting profile about them in the Times about how these two founders, like the same ones that are behind Alchemy before this, like started this consumer social app that ended up like rising to the top of the app store, but then falling down. And it's kind of crazy to see them go from like helping people try and make plans during lunch to trying to power the entire cryptocurrency platform.
I love it though, right? One thing doesn't work
crazy.
out, you move on, you don't give up. And, that's the kind of tenacity that leads to success. And, and to your point, Alex, that this infrastructure, the blockchain infrastructure is pretty hot. And we'll get into infrastructure more later in the show too, right?
Yeah. Well, it just goes to show that consumer social is really hard and building infrastructure is a little bit easier. Turns out selling to companies, slightly more consistent revenue.
Totally.
Let's just squeeze in one more really quick funny round before we jump into themes. Cook's Venture. This was one of my favorites from last week. I had never really heard of proprietary chickens before, but apparently they're a big deal. And so let me back everyone into this. Jordan Crook, one of TechCrunch's best, covered a $50 million financing into Cook's Venture, and they had developed, and I quote, a proprietary pedigreed line of chickens called the Pioneer. And Marianne, what I was surprised to learn is how particular feeding of chickens is in their kind of growth process. And so these, quote, Pioneer chickens, that's the brand name of the genetic line, this is a strange bit of English, are able to eat kind of a more diverse set of feed, and that's going to hopefully unlock kind of different farming rules and different farming applications in the U.S. And so I'm overall pretty enthused about this. I'm not entirely sure how chickens are venture backable, if that makes sense. Like that's the thing that I kind of got hung up on.
Well, I think part of the reason they were able to attract was $50 million in debt financing is that it was founded by Blue Apron's founders. So, there's some kind of a track record there, but agreed. I mean, I was fascinated by this story. I don't know a lot about chickens. It was interesting to learn a little bit more about chickens. I thought it was,
things we never say on equity. Yeah. We don't say that enough.
No, but Jordan did a great job of like breaking it down into like explainable language. And one of the things she said, like the chickens this way can handle a more diverse diet. They're more heat resistant. They get stronger immune systems. This means that cooks can partner with farmers in areas that have extreme heat or regions with food shortages. And I was like, well, now that's cool, So when you put it that way, like you can start to see some real life ways that this can be, improve lives and stuff. So
but I mean, it's a for-profit company, right? So like if they're gonna develop a chicken that you can grow in the desert, great. But if they wanted to charge lots of money to license it, the people who probably didn't have access to that before probably can't afford it. And that's the tension here. Like it's cool that we have healthier chickens because as it turns out, chicken is the most consumed meat in the US. I didn't know that. I thought it was beef actually, but turns out it was flat wrong. So very, very cool use of tech. I'm skeptical on the business model front, but as a carnivore, even though I know that's bad for the environment, I like the idea of more tasty chickens. Who doesn't?
As a vegetarian, I don't, but
that was for you, Natasha. I was like, yes. Yell at me.
Thank you. No, I mean, I guess going back to like your TAM question, like because chickens are the most consumed meat, I guess, there's the obvious impact there, but like if Impossible Meat and Beyond Meat are venture backable businesses, why wouldn't genetically engineered chickens not be? Is there something specifically about a chicken being alive that makes it not venture backable?
So
it's an ethics question. Hard topics today on equity.
I want to we have to move on in a second. We've gone over on these, but Beyond Meat, venture backable, Natasha says, very good point. It actually went public. And from a high, looking at the chart here, roughly $235 a share, it's all the way down to 63.
There we go.
So, kind of, maybe, I don't know, but I'm always here for things that take technology and make the planet better. So this is one of those, huzzah. If it's just to make fancier chickens for us Whole Foods assholes, less excited by it.
Agreed.
Let's move on and talk about the biggest thing that's been going on in the last couple of days, which is the meltdown of Peloton. I've been tracking this company for a long time, and I'm a little bit surprised about where we ended up. Natasha, can you just talk us through quickly about the CEO's exit and the layoffs?
You just took both of the updates I was going to give.
Well,
no, I'm just kidding.
Sorry.
No, that's okay. I feel like it's such a classic equity to like transition with like transitioning with what the transition person's going to say.
Well, you want to do a clean handoff,
No,
and then what
fair.
you do is you eat the food off the plate by accident, and then hand them the plate, and you're like, "Here, serve this."
It's better than like Peloton. Go. Like I feel like at least I know what to pick up.
Definitely.
We've gotten better.
Latest news with Peloton, we've talked about it on the podcast for the past month, and probably a lot more than that, is that they cut 2,800 jobs globally, which is about 20% of its corporate workforce. I feel like we haven't seen a layoff of this scale since maybe Airbnb in the beginning of the pandemic, which, I think we felt it. It was really sad and really tough because you don't see those numbers too often. But beyond those layoffs, we also saw that John Foley, the founder and CEO of Peloton, is stepping down. That comes after, I believe, an activist investor called for him to step down. How do we feel about a CEO leaving? Is that changing things for Peloton? Is this what they need?
Yeah, I mean, I have thoughts, a few things. I think this is a perfect example that a founder doesn't necessarily mean just because you founded a company, a good company, that doesn't mean you're going to make a really good CEO. And this is a prime example of that, in my opinion. There's been, I didn't know about this when I read the slide, the deck that this investor put out. I mean,
Blackwell's Capital. We'll put a link to that in the show notes. If you haven't read it, read it, and then be very glad you're not John Foley, because it does not make him look great. It's like the world's worst dating profile, essentially.
Yeah. I mean, it's really bad. Like some of the quotes that they've quoted him as saying, you have to wonder, like, was he trying to be self-deprecating? But it really came back to bite him in the ass. And oops, should I have said that?
I've been swearing, so I think we've decided by accident that it's okay to swear, and we'll just bleep it later. If you don't like swears, or you're under the age of like 12, I don't know, whenever you can start swearing as a child, turn off. Okay, Marianne, back to you.
Yeah. Okay. So anyway, one of the things that stood out, and this goes back to what the actual comment that I had made in the document, was that at the beginning of the pandemic, they committed to a 20-year lease on a massive office space in New York City. And that just, I'm like, who would do that? I mean, this is a time when everybody's like scaling back on real estate, wishing they could get out of either leases or, things like that. And why would you commit to a 20-year lease? And I feel like they were just way overly ambitious about the demand for Peloton's products throughout the pandemic. I mean, for sure, they saw a big surge. It died off. I think they were just too ambitious.
Yeah, I think the critique about the CEO is like twofold. On one side, we see people being like, of course, he didn't perfectly predict the end of COVID, the rise of COVID, the like Omicron, all of this. Like, how could he ever? And so those are people who are like pro John Foley, but the anti John Foley are kind of going on what you're saying, Marianne, of like he made decisions beyond just upping production of bikes. And I think that's probably why he had to leave eventually. And I think it's like a pandemic. It's like the end to a pandemic story. We will probably see a lot of other startups follow, maybe not something as dramatic as Peloton, but just this idea of like losing discipline and kind of having to play catch up as a result.
Yeah. If your company is enjoying a historic tailwind because everyone's at home and working from home, committing to a multi-decade expensive lease for an office seems strange. Like, the boom that's helping you is what you're betting against with your spend. Like it doesn't line up to me at all, unless you think, the same way you did 20 years ago, and then maybe it does. But I mean, it's a shocking oversight from a company that actually did very well in the pandemic. And as a Peloton user, big fan, rode mine last night and the night before. I'm on a 48-week streak. Huzzah. But I'll just say this, the software kind of sucks. It could be a lot better. It crashes a lot. I mean, they 2,800 people was 20% of their corporate staff. Hire 2 more developers to add some buttons to your software. It's not a big ask. So to me, I see mismanagement, not just at the accounting level, but also at the product level, if that makes sense.
Interesting.
I think I saw Kara Swisher talking about this on Twitter a little bit, of like their new CEO being a signal that they're prepping for a potential acquisition, because their new CEO, I think his name's Barry. Off the top of my head?
Yeah, I think that's right.
I'm probably right, like 20% of the time.
Barry Smith.
Yeah, like, okay, sure. But I'm gonna get in trouble for that. But I think in that way, I'm like, okay, it would be really interesting to see Peloton go through an acquisition. It would literally check off every single bingo board of how we want to see what a startup looks like after it's elevated and then deflated by the pandemic. So like my journalist heart is like very interested to see it go through talks.
Small caveat.
CFO of Spotify though, right? This guy? Sorry, Alex, didn't mean to interrupt you, but I just wanted to point that out, that the new CEO was CFO of Spotify.
Oh, interesting. Okay, cool.
So I think that's interesting.
A company with famous gross margin issues. But I just want to say to Natasha's point, she said that it's what we want to see. I think more like it's what we expect to see with companies that go up and then come back down. We're not rooting for Peloton's failure because then I'd have to buy a new exercise bike. We're just not surprised to see a company that seemed invincible for a period of time end up being a regular company, because it's rare that a company actually does manage to transcend its category and business cycles and so forth. So this,
we root for more data points coming. And we don't root for anything else than that, but more data points is helpful. And I think as we saw, I guess through earnings reports this year. Peloton gave us like a little bit of a benchmark to compare to. Alex, you covered Uber and Lyft. How are they comparing and contrasting to the way we're seeing Peloton kind of take a hit in the public markets?
Yeah. So if you recall, when the pandemic hit and lockdowns happened, Uber and Lyft fell off a cliff because everyone stayed home. We stopped taking rides. And then Uber Eats actually did a pretty good job filling some of that revenue back in for Uber. But Lyft really just got punched because they do kind of one thing, which is moving people, and no one moved. And so we've been tracking Uber and Lyft carefully because we care about what their results tell us about not just the on-demand economy, but generally about kind of out and about activity, because that impacts travel startups and all sorts of things. So we care about the data points. Q4 is pretty good for both companies. Lyft did say that Omicron had a material impact on its January results. So if you're out there building a company and you're expecting that all of a sudden things are going to be completely hunky-dory, not the case, notably. But I think we're seeing Peloton fall apart faster than we're seeing Lyft and Uber kind of like show a strong recovery, if you will. And so the news seems to be, I would say, very gently net negative, but not super harsh. Though I'll just say, I just went and picked up lunch before we recorded this. It's sitting 2 feet from me, just smelling like pancakes and killing me. No one's wearing a mask. Everyone's inside of a restaurant. Everyone's eating. So to me, like maybe the Omicron surge did ping January results a little bit or ding them, but people have seemed to just kind of move on to the next dish. It's part of their life. I don't know if that's good or not. Not kind of judging, but I'm just saying I think we've given up on pandemic restrictions. So I guess buy Airbnb stock or something.
Yeah, I mean, Marianne, I feel like we were talking about like this disconnect between the public and private markets. In your talks, for me, like I feel like I was hearing rumors of corrections in valuations for private startups. How are you hearing from the fintech world right now? Does it, match with what Alex is talking about, this kind of lukewarm, somewhat negative, but not the end of the world kind of feel?
No, I mean, I don't know. I don't know if it's just because I'm knee deep in like all the funding pitches and crazy valuations, but like I'm not really feeling that. I think there are some sectors within fintech that are a little bit have been overhyped or too saturated. But overall, it's still going pretty strong.
So the thing that I heard, Natasha, about this is that it's not really sector-based, it's more stage-based, the changes. So any company that's late stage, they are seeing their multiples compressed because the markets have sold off, but earlier stage startups are just raising like they did before. So there seems to be more price discipline the more mature a company gets, which is going to be strange for companies that are raising like a Series A or Series B at an incredibly high price and then have to kind of, endure a more mature multiple down the road. But, if you're an early stage investor, I don't think your competition's gone down much, especially with all the new funds, right? I mean, how could it be?
I mean, right. Yeah. I mean, speaking of early stage and just like the tensions we're seeing with new funds and so much money out there and so many just like, I guess, people betting their careers on entering venture. Last week on Friday, I believe, we saw tech Twitter kind of blow up about Lolita Taub, a really well-known investor, charging $400 for a pitch deck review. She is both an investor and also a startup advisor, all around a pretty vocal person for underrepresented founders as well. And I know I think we've all talked to her at some point. So I think that drama in and of itself is probably a conversation that is less interesting to everyone. But to me, I think what stood out is it struck a chord in so many different circles. People were mad about small fund VC economics, ethics, underrepresented founders. There was so much there. It's and I want to walk through all of it with you guys right now because I think it's important to unpack and I guess give people something to feel about it.
Okay, so I'll start us off then. So traditionally speaking, founders would go to VCs or investors of pick a variety and say, hey, we're building this, we're raising this much. Do you want to buy in? And then you kind of dicker around and get to a price point. The money always flows one direction though, or flowed one direction. You went to an investor, they gave you money. That was the end of it. This though is a bit of a mixing between investing and kind of consulting services, Natasha. And that seemed to be the tension that led to a lot of people being irked or upset because is it just because some bad actors have taken advantage of people in the past? Or is it more that the idea of an advisor taking a fee from a startup is inherently bad?
I mean, I feel like that there's concern over a conflict of interest, and one VC that I know pretty well named Charlie O'Donnell, he kind of hit the nail on the head, in my opinion, in one of his tweets. And what he was saying was some newer investors or VCs, it's harder for them to make money, right? I mean, it's different if you're a huge venture firm, but when you're just kind of starting out, you might need to do some kind of consulting. His criticisms are that, maybe don't charge too much because founders too are starting out and struggling. And B, this is what I really I think I agree with this. You cannot have as a client someone that you would potentially invest in. It has to be one or the other. And I think, it has to be separate, or then you get into this whole issue of potential conflict of interest. And one other quick thing. I did not realize that this is something that has actually been going on. Another very large investor apparently charges, I think, $900 for a 15-minute consult.
Can we just say who it is?
Yeah. And Andrew Chen, isn't that his name?
Andrew Horowitz, yeah.
And with A16Z. I mean, I nearly fell out of my chair when I saw the number. Like I was floored. And then, wait, it gets better. For a 30-minute session, it's almost $1,700. And then if you look at the page where he's offering this, sold out. So people are paying for it. So I don't know. I think when you look at it, when you've got this huge venture firm and someone's charging that kind of money, it's hard to feel good about that. I will say that he claims that he's giving that money to charity, but wow.
I'm going to share another data point right now that's going to blow both of your minds from the one and only Danny Creighton. Yeah. He wrote a story in 2019, which is like, should you pay $50K for your pitch deck? Yes. Why the hell not? Founders pay. I think this is like me taking a surprisingly pro-charging founders if they can afford it take of like pitch decks can be the make or break of your company at some point. I think that's like probably a separate conversation than the conflict of interest one we're having, because I agree completely with it should be either pitch or pay. But I think the idea that VCs should not charge people for advice is one that I think we also have definitely we've seen bigger numbers out there. So I feel like, I guess, conflicted. Those bigger numbers I think are coming from consultants agencies. So that might be the difference. But I think like the money you spent to get maybe a $3 million check, you get it back in minutes from having a better pitch deck. So I'm wondering if that's the argument these people are giving to themselves.
I don't think you should be spending $50K on a pitch deck and pitch deck assistance if you're raising a seed round. But if you're raising a Series D, getting some outside help to make sure that you're hitting all the right marks and aren't making an obvious mistake does, to Natasha's point, pay for itself really, really quickly. But we're talking about early stage folks here. I mean, like if you're pinging, an early stage investor, you're probably raising a smaller amount of money because why else would you be talking to them? And so the dollar amount is just much lower. And that's why I'm sympathetic to her. But I was late to this conversation. So I was like, what's going on? And people just started sending me DMs kind of explaining it. And most of the views that I got were like, well, if you run a smaller fund, the fee base is very small and not everyone's going to be an incredibly wealthy person already. And if you demand that they are, the people who can be investors is pretty constrained. So if you do want a more diverse investor pool, you're going to have probably a little bit more nuance, a little bit more flexibility at the earlier stages, provided there's no conflict of interest. So to me, this was kind of like 6 different arguments that started somewhere, but weren't actually all about the thing that happened. It was more of a catalyst point to kick off the conversations. But I don't think Lily is really in the wrong here at all. I don't have any beef with her whatsoever. And I'm glad that she started the conversation. I wish people had been slightly less rude about it.
I think also what's offensive is that here's a woman who is of Mexican descent, and she is known to have worked really hard to try to help underrepresented founders. And there was this huge debate on Twitter, lots of criticism, and then I find out that here's another investor who's been doing a very similar thing for I don't know how long, but yet I haven't heard any uproars about that. So I think that too struck a chord with a lot of people. It's just something's wrong with this picture.
Yeah, it's like kind of this really clear example of people being surprised by the expectations they hold of people. Like, why are they treating a woman of color different from a male of color? But still, it's like, it's tough in that way. And I think the point, I think maybe this will be the last that we could talk about a little bit, is like why it specifically, hurt some people coming from because of the underrepresented founder dynamic out here. I actually disagree with the fact that I do think if you're raising a seed round, paying money for pitch deck review makes probably more sense than a Series D, because you will only get to the Series D if you get a seed. If you get people to see that vision that early on. But I think if you're an underrepresented founder and you already are like so cash strapped, to pay and then like kind of pay to play, that's when it starts to get controversial. And pay to play, I think, is like the end thing that everyone agreed on. We should not have pay to play in VC, period.
Absolutely.
Yeah. Or journalism. I mean, just to be super clear about that. But so Natasha, I actually agree with you. But not 50K for your seed pitch deck. Like 5 seems pretty reasonable. 50,
much more reasonable.
50K is a lot of money.
Yeah.
I was only riffing. Yeah, I was only riffing on the Danny point of him saying 50K, why not? That's classic Danny.
Danny, you're so wrong right now. I hope he's listening.
Yeah, Danny, not only do we not miss you, but we're going to flame you whenever we can on the show because you can't defend yourself. And that's totally fair. I liked all this. Marianne, before we move on to the last thing, anything else you want to throw in here?
No, I feel like I got all my points out there. I mean, I think this debate was kind of important. And it's probably also important to note that I think people who are doing this are recognizing that they need to be more clear, I guess, about their motives or offer or explain that they're not pay to play. And, you know, maybe that's one good thing that's come out of all this. Like if people who are consulting are recognizing that they need to be more explicit in explaining the separation.
Yeah, I mean, here we are, 3 journalists getting together to demand more openness and clarity from industry participants. Wow.
We just always surprise our listeners. It's crazy. I don't have a theme at all. I love when tech Twitter actually ends up in like being something worth talking about on this show, because we don't always bring it up because it's not always interesting and usually it's kind of petty. So I'm sad that there was bullying, but I'm happy that there was a, I guess, takeaway.
Right. Yes, but this goes back to the thing that I wrote in defense of drama, asking for more arguments in tech Twitter because they can be clarified. And I think this did actually unlock a lot of stuff for people that may not have known what was going on, both pro and con. Again, I didn't need to be rude. That was an unnecessarily poor component of the overall conversation. But did we all learn something? Yes. Did an industry practice become less occluded? Yes. So, you know, drama. Let's have some more of it this year. Let's get some fights. Next time, let's just make
it between 2 white dudes and I will be much happier.
Bring Danny back on the show. I mean, and I will deliver.
Let's end with Insurtech. I mean, we haven't talked about the sector in a long time. Alex is banging the soul drum. Is that the phrase? About Insurtech. Why do we care about it right now, Alex? You've written a ton about it in the past few weeks.
Yes. Well, so what happened was back in 2019 and early 2020, a lot of companies were talking about raising lots of money for their insurance products. Metromile, Root, Hippo, Lemonade. These were companies that were growing quickly and were talking a really big game. The problem was I didn't know anything about insurance. I didn't know about loss ratios or loss adjustment expenses or how to build a book of insurance or anything that was going on. So essentially what I had to do was go learn all that stuff. Then they went public, that whole collection of companies. And I was like, okay, great. I figured it out. They went public. Now what? And then they all got wrecked by the public markets. And so we anticipated that venture capital interest would tail off. But Marianne, in the fintech world, did we see venture capital activity tail off last year?
Well, not at all. I mean, quite the opposite. This is an example of like public companies doing really poorly while funding still like really, really flowing into a certain industry. And so like, was it record numbers in Insurtech last year, Alex? Is that right?
Yeah, it was record numbers. So like all of fintech, like most of venture last year was amazing. And just for example, there's a startup called Alan that we talked about on the blog the other day, a French startup, health insurance as a service, also offers a platform, just another example of a company in Insurtech that's raising a lot of money. And I bring it up because what we've seen is a real kind of dichotomization of the Insurtech market, because companies that were doing their own insurance underwriting exactly have struggled with some exceptions. Next Insurance is doing pretty good. WeFox over in Germany, but it seems that the companies that are doing more like providing services to the insurance industry are doing better. And so I almost think we need to break Insurtech into 2 parts.
Yeah, we're definitely seeing a lot more of the infra startups emerging and a lot of money going into them. And I feel like the demand is there, not just from the incumbents, the insurance companies that have been around for decades, but also from some of these newer ones that are still not quite there yet. So rather than trying to build the technology themselves, they can it can work with these infrastructure providers and really help, boost their offering. And then the infrastructure providers are like, raking in the dough. So I think it makes sense.
I think it's a really sharp take, because there's like, it's similar to like ed tech or like climate tech. Like these sectors are not like all equal when it all depends on the business model and the founder, and so much about who they're selling to. And so I think it's like, yeah, it's about time for Insurtech to kind of drop off some of its maybe sad reputation from the public markets we've seen so far. Alex, are there any startups that I guess are heading towards the public markets that will give us new data points of business models? Or is it still a ways away before we could see a new Insurtech have to prove itself publicly?
Well, I think there's going to be companies that are of sufficient scale to go public in the insurance space who are not neo insurance providers, the exact category you're asking for. But there's also so much money sitting around that they don't have to go public. And why would you go public now if you just saw companies that could be construed as not comps per se, but cousins get wrecked? Just for example, Lemonade traded up to $172 a share, give or take. Currently we're 30. And then Metromile, Root, and Hippo are all way down at the $1 to $2 per share range. So it's a massacre out there.
Did you say $1 to $2 per share range?
Yes. In fact, I'll just be rude and Googling it. Yep, Hippo's $2 a share, and then Root is I think like $1.30, $1.86.
Let's compare it to Snowflake.
Okay, so to be clear, the per share value is only half of a market cap calculation, but it does go to show what's happened to these companies. Yeah. Natasha, that's your question. The Zebra, I think they said they crossed $150 million annual run rate.
I think it was $100 million in annual revenue. Yeah,
there's one. I think they gave us a new number for the story that Anna and I wrote. But
I'll have to double check that one. Okay, yeah. I think they're here in my backyard. I've been to their offices.
No way.
Really?
Yeah, East Austin.
Austin pride. I mean, it's a good city, really good tacos. And then I would say Agent Sync is the other one that I'm keeping an eye on. They've raised like Alchemy, they raised a zillion rounds in quick succession, lots of growth there. They're too small to go public still. They're probably in like the 15 million ARR range, give or take. But I think, give them 18, 24 months. I don't see why they couldn't if they wanted to. So there's optimism there, but the saga of the neo insurance providers was one of Icarus. And they have melted their wings and crashed back to earth.
I could think of no better metaphor, so I don't want to follow up on that. I mean, that's the takeaway, guys. This is why Insurtech is so relevant. It gives metaphors like that.
If you can't bring up Greek mythology on the podcast, what are we even doing?
Right.
Okay, so before we sign off, though, and say goodbye, we need to point out that we will be doing equity on Hopin and kind of distributed everywhere every other week. So next week at this time will be Found, our sister podcast with Jordan Crook and Daryl Etherington, talking to founders about what they've done and how they've done it. And then Welcome Back to tell jokes and bring up Icarus the week after that. And we'll trade back and forth. And I think we're doing this in perpetuity. So if you like watching us use our faces and not just our voices to record the podcast, you're welcome to drop by. It's free, of course. And we're going to take questions here in just a minute. But before we go, Marianne, Natasha, last comments?
This was fun.
It was fun. Yeah. I'm like, it just hit me now that you said that I need to find new clothes to wear, because this is like my go-to look normal shirt. So we'll prepare for that offline.
I thought actually we could go down a notch, because now that we've done one of these and we've shown up that we can wear normal clothing, can we just go back to being comfortable again?
Not wrong. Hairforward or equity merch. Actually, we have more people at backstage than usual, and I feel like if we get them on our side, we'll be unignored. The march for equity merch continues.
It took us like 3 years to get our own Twitter account. The march is going to be quite a while. Anyways, guys, this has been Equity Live /recording. We're coming to your ears Friday mornings. Of course, we'll be back on Monday and Wednesday and Friday of next week. Hugs from us. We'll talk to you soon.
Bye.
Bye.
Should I stop recording?
No, you can keep it going.
All right.
Give that recorded go. We'll record the after party, which is where we are right now.
How did it sound?
So far, so good. I mean, we're still live on Hopin.
Oh, so I know, that. But like, yeah. So okay,
yeah, good, yeah.
So
it
wasn't like
fewer fuck
like,
ups than I expected. Best we can hope for.
Yeah,
all right.
I thought it sounded fine.
Yeah, well, we got some questions from the audience that would like to mainly about Peloton. So from Haya, lovely Haya from the TC staff. Do we know anything about what happens to Peloton's content if the company implodes? I know you all don't have insider information, but do you have any ideas?
I have a thought.
Yeah,
and this is why I was excited about the potential Apple acquisition, because Apple Fitness Plus and Peloton's content like go together so well. I'm pretty sure Apple just like copied Peloton. Sorry, if I got that wrong, but I feel like there's such a perfect mix there. And they have Peloton has done a better job than Apple has with like creating famous influencer like fitness creators. So I feel like it would be great for them to have a new life to live there. I'm surprised that they haven't like spread their eggs across more platforms.
Well, surprisingly, we did an episode way back in the day talking about whether Apple should buy Peloton back when Peloton was at the peak of their deal. If that comes true, man, Alex, we're gonna have to have Iris back on the show and be like, we were right.
That's the show.
It's so rare that we're right in predictions.
It's like Oracle and TikTok.
No, right.
For people who don't know, Equity does a end of the year show in which we do predictions, and historically, usually by January 15th, Chris, they're all wrong is usually what happens. It's pretty quick.
No, what you're talking about, mine are always right. I think I do really well.
The end of SoftBank.
I do great.
Just got one thing right. I want to answer the question that Haya said this. So I just pulled up their fiscal second quarter 2022 earnings, and to my surprise, actually, their implosion is not an impossibility because their second quarter operating cash flow was negative $447 million. And they only had 1.6 billion in cash. So they have money, but like they don't have infinite money at that pace of loss. So that's kind of terrifying, actually. So I think what would happen is that we put into receivership, and then whoever kind of picked up the bones in that case would get the content. But much like tweets, it has decaying value. Like people want to have the next exercise with coach X or Y or Z. And so I wonder if the back catalog actually has a lot of value. I don't know.
Quibi's going to pick them up.
You heard it here first, folks.
Okay. In that theme, Anand Thankar asked about predictions of where Peloton could potentially go, but it kind of sounds like Peloton could limp along for a while independently. What are y'all's thoughts on acquisitions for Peloton?
So much money. I paid them $40 a month. What the fuck?
I don't know. I feel like it really took a lot of work to make a company that's really become like a household name and so well known in the mainstream world. Like, everybody pretty much knows what Peloton is, but not everybody, but you know what I mean? Yeah. To be in a position like this, I mean, I don't know. I mean, I'll be curious. I have no idea who's going to try to buy it. And if they do, how much they'll pay for it. But this is all kind of sad and shocking in a way.
Yeah, it's a disappointment. My Peloton no longer looks cool. Like when I got it, I was like, yeah, I got it in like late 20. And I thought I was like the coolest guy in my boring neighborhood block.
I remember that.
I was so excited.
I remember when you were like, my Peloton's not here yet. I can't believe it.
Oh my God, yeah.
I mean, I still use it all the time, but like I no longer feel like hip. I'm always just like, oh yes, the middle-aged man on an exercise bike.
It's chuggy. It's definitely chuggy. You're chuggy for sure. That's what Amanda told me. So I'm gonna go with that.
Is that the first appearance of that word on this show? Is that the first?
I think so.
Cheers, guys. That's huge for us.
Thanks, Amanda. I appreciate you. Trying to be relevant.
Who do you guys think is definitely not going to acquire Peloton?
Microsoft.
Microsoft.
That's a safe bet.
Microsoft is a good one.
Microsoft is a good one.
No, real
Twitter.
talk though, dude. Does anyone actually have like is anyone willing to make an actual guess while we're here about who, if Peloton is sold, who the acquirer will be?
I mean, I'm with Natasha on the Apple Fitness makes sense to me. I mean, maybe if the price could come down. But
okay,
it would be a logical thing, but I don't know. I'm still a little skeptical that Apple would buy Peloton.
I mean, the other name I heard floated was Amazon, and I can see that being, just another reason to subscribe to Prime, right? Prime is the main reason why they are continuing to to be so big. So why not make another thing to bring people into Prime?
You know what really makes me kind of like doubt my personal finance abilities? I was just thinking about how the price of Prime's going up by $20 a year, and everyone was like freaking out. They're like 119 to 139. I'm going to cancel it. And I just realized that if I spend $40 a month on Peloton, I give them $500 a year.
Oh my God.
So I can have stats on my cycling, which I could just turn off and not use. But for some reason, having the little charts is apparently worth 500. Okay.
Wow.
All right. Data point.
Branding.
Let's do some more questions before I realize more truths about myself.
Some of the other questions were more on the animal, the chicken. That really kind of spurred people's interest. So we also have, when covering animal startups, does it sometimes inspire you to become vegan?
Yeah,
Yes.
I mean, true story. My brother, as a child, witnessed my grandfather kill a chicken, and he never, ever again ate a chicken or ate chicken or turkey. Yeah. So, I mean, it does feel kind of yucky, and Natasha can speak to it firsthand, of course.
Yeah, I know. I'm vegetarian. I think about veganism all the time. I don't cover like that space enough, but like we are starting to plan our climate event. And I could totally see there being a world in which I learned too much for my own good and stop eating cheese as well. So I think it is just like also hearing people talk about like animals as like a kind of like venture backable business can like sit weirdly at times, I don't know. Don't love it.
Yeah. I was in 4-H as a kid, so I've raised livestock, and I've taken them to the county fair and sold them. And the first time I realized what was going to happen to the sheep that I had raised, which I named Winston, by the way, I cried for hours. Like I remember like walking across like the parking lot at the county fair, my mom like holding me as I just cried because my sheep's going to get killed.
Aww.
And then the next year I got another sheep for 4-H, and it was the exact same sheep, because it turns out sheep don't have personalities because they don't have intelligence. So chickens and sheep, I'm opposed to factory farming. I buy fancy hippie meat whenever I can, but I do think though environmental concerns and ethical concerns are pushing me more towards vegetarianism. I can't give up, all animal products. I don't think. I do have some vegan friends, but I think yes, the more you learn, the less comfortable you are with kind of what you eat. So it's a good thing.
Totally.
We have another question from Anand, who first says, appreciated your covering the VC offering consultative services, and then asks, anyone you know that does an ideal blend? Or even, what is the ideal blend?
Yeah, what do you think they're talking about? Blend between free and charged? I was having trouble understanding exactly what the question was. What do you all think?
So my read here is that VCs offer a lot of services as a differentiation point. But that does tend to come at the firm level. Like once you have like an institution that's raising a pool of capital that they're trying to invest. I think really what we're talking here more on is like the individual investor who probably has between, $1, $3, $5, $7 million in capital, and then basically consulting as a way to kind of keep the lights on. So the ideal blend would be for everyone to have enough money to not need to do it. But I just don't think that's going to be a possibility. So I think Marianne's point from earlier about maintaining a very firm ethical divide between consulting and investing is probably about as best you can do. And then it just comes down to the quality of the services provided and, how much do you know? But it's tricky, but I don't think it's impossible to do it well.
I don't really know of anyone else. Honestly, this was like the first time the topic had come up for me this past weekend.
We'll see Lolita probably rephrase some of her wording per her partner, Josh. He did a Twitter thread because I think he helped set up the tool that was kind of under all this controversy. And they committed to changing their wording in some ways to make it clearer. So the perfect blend is probably like, I would hate to see like underrepresented VCs or emerging fund managers who need money and want and should rightfully monetize their talent, like not charge for advice, but like very clear language. Like if you weren't thinking about it before, you probably are. Hopefully that answers the question.
Yeah, like there shouldn't be any doubt. If someone's coming to like your website or whatever, there should be no confusion as to, what the services are or how to pitch and how they're distinct and all of that. It needs to be like super, super clear up front.
It's tough though. I was thinking about this. Like I was like, if I was doing this and I was like, if I was like, okay, you can either pay me or pitch me, but what if you pay me and like you have the best startup I've ever seen? Like that's kind of like this like bait for you. And so like if I was, I don't know. I mean, I feel like if like you're saying, kind of saying, Alex, like if we had all the money in the world, then I'd probably do one or the either.
Well,
but
okay,
tough.
I have an analogy. It's kind of like if we were media consultants, right? Like it just, yeah, exactly. I mean,
yeah,
we
that's
can't,
true.
we can't consult with a company.
We do pitch deck teardowns all the time, but I think we do them for free, right?
Yeah.
Like
we do them
on
for entertainment.
Yeah, and entertainment. Yeah, free for the exchange of entertainment. But yeah, I think the relation between VC ethical concerns about charging for advice and pay to play for journalism there's correlations there for sure.
Yeah, this is why when TechCrunch gives 50K to the winner of Disrupt Battlefield, it's just free money. We're not taking a stake. Right. We're not trying to own part of it. It's just, hey, thanks for coming out and showing off what you got. Winner gets 50K. The effective dollar amount has gone down a lot as venture has expanded. 50K used to be a pretty good check when we started off Battlefield. Probably have to raise that up at some point in time if we can afford it. But that's why we don't take a stake, to avoid the ethics and the issues thereof. So.
Okay, I got one final question, and it's not really about the topics of the show. It's a little bit more public market reaction. So Netflix traded at $700 a few months ago, and now is trading at just below 400. What's y'all's read on? Is this some overreaction by Wall Street? Overcorrection? What's our read on the remind me. They went down because their growth slowed post-pandemic. So they're like suffering from the COVID boom ending is what I remember.
Yeah. I think Amanda wrote a story for us about like they had their lowest year of subscriber growth since 2015. And I can totally see a reaction of that sort of magnitude if you're seeing 2015 levels, especially with Netflix and it's like whole content factory. Like I feel like Netflix in 2015 and Netflix in 2022 is like so different. So surprising to see their subscriptions drop or grow less, not drop.
Right.
But then it's also like the number of people that are already subscribers, right? I mean, if I don't know the numbers, but like once you get to that level of having so many subscribers, it seems like eventually the growth has to slow down.
Yeah. I think what also happened was they had a pull forward. They didn't just see accelerated growth and then deceleration. They essentially took growth that was going to come a year or two later and pulled it forward, which is great. But I think that Wall Street, for some reason, didn't think that was going to actually lead to slower results down the road. And so to me, this is not Netflix making a mistake. This is more Wall Street having its expectations kind of wrong. I haven't done the hard work of going back and checking their projections versus actual results per se, but like, it's enough of a deceleration in valuation that, again, investors should have kind of known better. This feels a little bit like Peloton. Of course, at its absolute peak, it wasn't going to hold up that growth rate forever.
Of course, gyms were going to open one day again.
Yes. Yeah. But my friends are already back in them, and they send me texts. I'm very jealous because they have more machines than I have at home. But I mean, Netflix at $400 is still worth $177 billion at Esh. So like, it's not exactly a cheap company. Still, it pays no dividend. I don't think it does share buybacks. So it's still expensive. It's just slightly less exorbitantly so. So maybe their overreaction was before, not now.
Right.
Alex, maybe they'll get into gaming. They
already are getting into gaming.
Yeah, but maybe that's their success story now. Like maybe we'll see them.
Like how ghost kitchens make kind of generic food that you can sell on like Uber Eats and stuff. So you can get like a cheeseburger. That's how I feel about Netflix content. They make content. They're like, we'll take this celebrity, that theme movie. And you know what you get? Mediocre fucking cheeseburgers.
Do the job, but nothing to write home about.
Yeah. Like if you're driving by, but like you're not going to like seek it out. That's the issue I have with Netflix.
I mean, that's why I will always pay for HBO. I mean, HBO is just like,
there's been some good series that have original content on Netflix.
Squid Game, guys. Right. Do we remember Squid Game?
I mean, if we want to get into this debate, I have to say
I got one more.
We're too close to the end. Yeah.
Okay. Shows.
What?
I thought Marianne was going to tell us what to watch on Netflix.
Oh, well, Ozark. Hello.
Basic.
Ozark.
Ozark?
Oh my God, Alex.
You haven't heard of Ozark?
Oh,
I don't think
What's
I haven't.
It's not science fiction.
Well,
no, there we go. On that, Alex needs to go watch Ozark,
Yeah.
and we need to go get off of Hopin. And Alex, will you give us a sign off for me?
What kind of sign off do you want, Chris?
Just tell everyone goodbye, and that we care about them.
Well, thank you all for coming out to our first live show of 2022. We will be out and around as a company this year. TechCrunch is coming back to live events, but we're also doing quite a lot virtually. So you'll see quite a lot of us. Follow Equity Pod on Twitter if you're so inclined. Bay Area writer for Marianne, __ for Natasha, Alex for me, and then Chris and Grace don't really tweet, so it's all good. We adore you. We'll see you soon. Bye.